James Hughes, Chief Market Analyst here at Scope Markets, and this is your daily briefing. Investors focused on China during the Asian session of trading as various headlines added to the tensions between both China and the US to drag shares and futures prices lower. Hong Kong was the biggest drag on markets after Beijing looks set to impose a new security law on the city after the uprising last year. This was met by comments from President Trump stating that the US would react very strongly to any move. It was yet another sign that the US will continue to ramp up its overall offensive on China. Washington has continually blamed China for the coronavirus pandemic and last week blocked any chip supplies from the US to Chinese tech giant Huawei, as well as passed legislation to make it harder for any Chinese firms to list shares on exchanges in the US. Currency markets have been fairly stable overnight, despite China also stating they would not be setting a GDP target for the year. This is the first time in decades, and it came after it pledged to pump more money into the system to help stimulate economic growth. The lack of a target being set is an acceptance that the Chinese economy will get nowhere near the usual targets of around 7% growth, even with a recovery towards the end of the year. The yen saw minimal movement despite the Bank of Japan announcing further stimulus measures at an emergency rate-setting meeting. Governor Kuroda launched a 30 trillion yen lending package aimed at small businesses that are struggling to stay afloat during the crisis. Combined with the previous lending program and its government and corporate bond buying, the Bank of Japan has now added 75 trillion yen to help the economy, while the government have added 117 trillion yen. The move had been widely anticipated by the market, so saw little movement in yen currency pairs. This morning we have already seen retail sales released from the UK, with numbers coming in slightly worse than expected at a terrible negative 22% year on year, and saw retail sales in April alone fall by 18.1%. The poor numbers saw sterling come under pressure across the board, with sales of clothing the number one worst hit, falling by 50.2% compared to the numbers in March. Every sector apart from food sales slumped lower, while of the proportion of those sales that did take place, 30.7% more of them took place online. With lockdown set to ease further in just over a week, it remains to be seen if many retailers can afford to reopen their shops when it does. Marks & Spencer's, the retail giant in the UK, have already warned that the way we shop could have changed forever. So the big question will be whether high street retailers reopen at all when social distancing measures mean that they are forced to not let as many customers into their shops. As we approach Friday, oil prices remain stable, stocks look set to open lower for the Europe and the US, but markets will be nervous after we've seen an incredibly volatile week.